Yeah, hello, good evening, all.
Good evening, sir.
Good evening, sir.
Cool. All right. Welcome back from the break. The class will return to the normal 8:30 now. We are still on option theory and valuation. We have explained the concept, option markets, a financial market where investors can buy or sell options. This option is a right to buy an asset or a right to get an asset. The word option is defined as the right to buy an asset or to sell an asset at a pre-specified price. It's a right, but not an obligation. The option holder will need to exercise his rights to buy or his rights to sell. The option holder will need to exercise his rights. His right to buy an asset or his right to sell an asset. That means something must motivate you. Something must motivate the option holder to be willing to exercise his rights. These rights involve payment of premium, the option premium. Option premium must be paid to obtain the right to buy an asset or the right to sell an asset. The right to buy an asset is the call option, while the right to sell an asset is the put option. Hence, you might be required to calculate put option price or call option price. The put option price is the amount payable to obtain the right to sell an asset. The call option price is the amount payable to obtain the right to buy an asset. So the examiner can ask you to calculate put option price or call option price. For your exam, I can recommend Black School option pricing model. a mathematical model that can be used to calculate the price of a call option or the price of a put option. Last week, we look at question number 1, page 110. Tonight, we are looking at question number 3. Please check question 3. I think page 111. The question on Benko PSC. Can somebody reconfirm the page? Usman is not available tonight again. You must be having problem logging on.
Hello, sir. I'm in class.
Oh, it's available.
Hello, sir.
Let me reconfirm the page. Oh, page 110. Page 110, question 3. All right, let's go to this question together. You can mute. An investor owed 500,000 shares of Benko PSC. We have an investor. This investor has shares, 500,000 shares of a company called Benko PSC, and is considering buying some put options to hedge an investment. Benko's current share price is 60 naira. The risk-free rate is 12%. Recent volatility, in bracket standard deviation of the shares, has been 30%. She requires European put options with an expiry, with an exercise price of 50 naira and expiry of 2 years. Requirements A. Calculate the value that a bank is likely to charge for 500,000 put options of the investors require specification. The question is very direct. Value 500,000 put option. This question is very direct. Determine the value of 500,000 put options. In this case, you can, unlike the question we solved last week, put option. We use the formula for put option directly. Unlike the question we solved last week, examiners say calculate value of put option. We now use the formula for put option directly. You can do that. Or you can calculate value of call option first. When you get the value of the call option, you now use that value of the call option to calculate value of put option. You can equally do that. Either approach will give you the same results. Let me repeat my point. You are required to calculate put option value. You can use the put option formula directly, or you can use call option formula. Calculate call option value first. When you get the value of call option, you can now use that value to derive value of the put option. Either approach will give you the same answer. So I want to use the approach of call option so as to also teach. I'm going to copy formula for call option. I'll use this approach. I also want to use this approach to teach. Please don't forget text. Calculates value of call option using Glasgow option last code option pricing. Let us calculate the value of call option. That is the price of call option. This is the formula for call option. Your XO, current stock price. The stock price currently is 60 naira. Your capital letter E, exercise price. The exercise price is 50 naira. Time to maturity. The maturity is 2 years. The risk-free rate. Examiner said risk-free rate 12%. Look at it, please. The risk-free rate is 12. Volatility 30%. Just pick your variables, please. What you needed most now is to pass the exam. Identify the 5 variables you require. Risk-free rate 12%. That is equal to 0.12. Volatility represented by standard deviation 30%. That is 0.3. We have identified and picked the 5 variables. Calculate your D1. Look at the formula. From the formula, you have ND1, ND2. We need to calculate MD1, ND2. That reminds me, sorry. Somebody chatted me. I'm not sure if it's online class or physical class. And said, we didn't raise this to power. That we didn't apply power. Please note, that exponential function automatically implies power, raised to power. Once you introduce exponential function, any figure you are putting is raised to power. Now, calculate your D1. Look at the formula. D1 is equal to our D1 D1 is equal to in. In is your natural log on your calculator. Bracket XO, current share price 60 naira, divided by capital letter E, exercise price 50 naira. Close your bracket, plus open another bracket, small letter R, risk-free rate. The risk-free rate is 0.1. plus 0.5 multiply by 0.3 volatility. Please allow me to move this to avoid story that touch. My D1 is equal to in bracket 60 over 50, close my bracket, plus open another bracket, risk-free rate 0.12 plus 0.5 multiply by the volatility 30%, raised to power 2. Everything multiplied by T, multiply by 2, divided by volatility 0.3, multiply by the square root of 2. Please apply your calculator. Where is Charity said? Please apply your calculator and give us D1. On your calculator, look at where you have in. We are waiting. Oh, who is done? On your calculator, you have in 60 divided by 50. Close your brackets, plus open another bracket. 0.12 plus 0.5 multiply by 0.3 raised to power 2. Close your brackets, multiply by 2. Then divide by, a bracket is needed to cover the 2.3. Multiply by the root of 2. Final answer, 1.2076. Your D1, 1.2076. Akko, are you reconfirming?
Sir, I got 2 point something, so I'm recalculating.
I go 2.2 something.
Yes, I got 2 point something.
I got 1.20754.
Oh.
Tosi. Sorry, I'm just taking my. Akko, are you reconfirming this? I didn't hear that.
You're not looking at this online. You're not looking at this phone. So if you're watching yourself,
Who is speaking? The volume is low. We can proceed, right? Yeah, okay, that's fine. Laura has reconfirmed. You now move to your D2. Your D2 is equal to D1, 1.2076 minus volatility 0.3 multiplied by the square root of 2. You place this in bracket. D2 0.7833. You have resolved D1 and D2. You have resolved D1 and D2. Next, ND1 and ND2. Determine ND1 and ND2 using normal distribution table. Subject to 0.5 plus or 0.5 minus. Pick your D1. D1 is equal to 1.2076. Establish a range. This number range between 1.20 and 1.21. This number, 1.2076, is between 1.20 and 1.21. Now go to your ND1. Your ND1, recall, if the figure, your D1 is positive, our D1 is positive 1.2076. You are going to start your ND1 with 0.5 plus, open a bracket. Now go to your normal distribution table. Check 1.2 under 0. Look at the table here. 1.2 under 0. 0 is up here. Look at it. You have 0 here. 1.2 here. 0.3949. 0.3849. Pick that figure. 0.3849 plus you have checked 1.20. You are left with 0.06. 0.76. That is the remaining number. Open another bracket. Go to the table again. Check 1.2 under 1. 1.2 under 1. 0.3869. Zero 0.3869. That is normal distribution table. 1.2 under 1. Then say minus the figure you get initially. 0.3849. Please work this out. That will give you your NG1. We are going to get 0.8864. Please, you can reconfirm this. We now move to D2. Our D2 is equal to 0.7833. This is our NG1. Establish a range. This number range between 0.78 to 0.79. This number is in between this range. Your ND2. Look at your D2. Positive 0.7833. You are going to start with 0.5 plus. Open a bracket. Now go to the log. Check 0.7 under 8.
Oh, sir.
Look at the log here, John. .7. Now count to 8. 0, 1, 2, 3, 4, 5, 6, 7, 8. 0.2823. 0.2823. Is your any problem?
Sir, please, how do you get the 0.79?
Please, at any point in time you want to ask a question, please indicate. I don't have my air device plugged to my head.
Okay.
Establish a range. This number 0.7833. Where would this number lie? In between 0.78 and 0.79.
Okay. Okay.
At every point in time, you are trying to calculate ND1 or ND2. We are going to have 4 decimal places. Your
Okay.
D1 or your D2. You now
Yes, sir.
establish a range. This number is between 0 is greater than 0.78, but less than 0.79.
Okay, sir. All right, sir. Thank you, sir.
So here we have 0.2823. That is under your table, normal distribution table. You check 0.7 under 8. Then plus, look at the number, D2, 0.7833. Pick the remainder, 33. Take it as 0.33. Open another bracket. Now go check 0.7 under 9. Look at the table here. Look at 0.7. Look at 9. 0.7, I will take it to 9. The figure here is 0.2852. Zero 0.2852. Then minus the figure you get under 0.78 minus 0.822823. Please work this out. That will give you your ND2. Please do your calculation, subtraction, addition, multiplication. You are going to get 0.7833. Please note, this is just coincidence that D2 is the same as ND2. Please note It is just coincidence that we have the same figure. Now, let us calculate value of the call option. Let us remove this. We want to get value of call option first. Then we can now use that value to calculate value of put option. Look at the formula for call option value. You have gotten your ND1 and ND2. Value of call option. Value is equal to C is equal to C is equal to your XO, current share price, 60 naira, multiplied by ND1, 0.8864, minus exercise price, 50, exponential, minus risk-free rate, 0.12, multiplied by time to maturity, 2. Please note, if you have two numbers, you are going to put it in bracket when you get to your calculator. A student will ask me, why do I need to put that bracket? Calculator will take it as 1. If you do it individually, calculator will change the answer for you. Then multiply by ND2, 0.7833. Now let's apply our calculator. $60 multiplied by 0.8864. You can do it 1-1. C is equal to, this will give me 53.184 minus 50. To get your letter E, exponential, go to your calculator, do shift or second function, then go to where you have in. the exponential function will come out. Now, because you have two figures up, introduce brackets minus 0.12 multiplied by 2. Then get your answer. You are going to get 39. 331393. Now multiply by 0.7833. Here you have 8. We are trying to create space. Value of the call option. We are still going to need space. T is equal to 53.148 minus 30.808. We have 22.376. You have gotten the value of a call option. You can now using put call parity theory. Using puts call parity formula. Or theory. What is the theory? Let's go and take the formula. This is the formula. C E capital letter exponential RT is equal to P plus X. Your C, that is the core value. We calculated 22.376 plus capital letter E, the exercise price, 50 exponential small letter r, 0.12 multiplied by 2 is equal to our P, the put price, what we are trying to calculate. Our S, the current stock price, 60. P. This is 22.376 plus 50 shift in shift in negative 0.12 multiplied by 2. This will give you 39.331 is equal to P plus 6. Let's expand this again. One more. This will give you summation 61.707 is equal to P plus 60. What is P? Collect license. P is equal to 61.707 minus 60. Therefore, P is equal to 1.707, approximately 1.71. That is the put price per one. If you try to follow this question, what you are asked to calculate is value of 500,000 put option. We now started from call. We calculated price of a call option. The price of a call option. To derive the price of a put option using put call parity theory. You have gotten price of a put option. Now, valuation of 500,000 puts. Total put option value. One is 1 naira 71 kobo. If now 500,000 put option, 500,000 put option multiplied by 1.1. Please compute. It's 5500. That is the value of 500,000 put option that is the premium the investor will pay to buy 500,000 put option. We are done with requirements A. Any question, please? I've not told you. Who is that? Any question, please? No question. All right. Let's try to study it. You are signed up to write the exam. May God give us a better understanding. Requirement B. Please hold on. You can go ahead.
Okay. Hello, sir.
Yes, I can hear you.
Please, can you just guide me on calculating this exponential, because I've been trying to arrive at the same figure with you, but since I'm not.
Okay, which area are we looking at now? Did we
The,
compute D1 or
the how to use the calculator in calculating that exponential function? Yeah, I've pressed shift and I've arrived at.
Let's take this. Look at this. Let's start over.
Okay.
50. Press 50 first.
Yes.
Now go to shift. Press shift.
Yeah.
Now go to where you have in on your
Yes.
calculator.
Yes, I
Press
have E.
in.
Yes.
So the letter E out, Navi.
Yes.
Now introduce open brackets.
Okay.
Minus 0.12 multiplied by 2. Close your bracket.
Yes.
Obtain your answer first. What do you have?
39.33. 331.
Correct. Correct. Now multiply the answer by 0.07.7833.
Okay. Okay. Thank you very much, sir.
You are welcome. Requirement B. Please, let's try. We don't know what the examiner will say. What we can do as much as possible is to try to address your syllabus. Requirement B. Is the investor's position. $500,000 shares and 500,000 puts edge. If yes, explain why. And if no, advise on the number of put options needed for a proper hedging. Let's try to explain the requirement. This investor has 500,000 shares in the company. She now decided to buy 500,000 put options on the assumption that one share is equal to one put option. She assumed on her own that one share equals one put option. Examiner is now asking us, is the investor's position edge? If your response is yes, if your response is yes, explain. The appropriate response is no. The investor's position is not edge. The appropriate response to that question is no. The investor's position is not edge because the data of the put option is not considered. If 500,000 puts are purchased, if you recall our explanation, under data, data is used for hedging. The investor cannot just assume that because I have 500,000 shares, I'm going to hedge by buying 500,000 put options. Before you can talk of hedging, you must introduce data. So the investor's position is not hedged because the data has not been considered. Now, let me now say, if your answer is no, advise on the number of put options needed for a proper hedging. How many put options do we require to properly hedge 500,000 shares? In this case, we are going to represent the number of put options needed with letter X. We are trying to calculate it. You now create a portfolio. If you have followed this topic, we started 3 weeks ago. we explain data hedging. We are going to create a portfolio of assets and options. Your asset is your share. A portfolio containing assets and put options. The asset is the shares. How many shares do we have in this question? The investor have 500,000 shares. The shares represent assets. What is the data of an asset? Let me refer you to it. Please look at it. Data of an asset is 1. Data of a call option, ND1. Data of a put option, ND1 minus 1. Return here. Data of shares is 1. Total, 500,000 multiplied by 1. 500,000. Put options, I don't know yet. Represent it with X, letter X. Data of put option, ND1 minus 1. We can work it here. Data of a put option, ND1 minus 1. What is your ND1 figure? 0.8864 minus 1. That will give you negative 0.1136. Data of a put option, negative 0.1136. Total put option data, X multiplied by D, negative 0.1136X. And we said data neutral must equal to 0. Total data must equal to 0. That is neutral position. What you are saying is 500,000 plus bracket minus 0.1136x must equal to 0. If you are to achieve neutrality, neutrality means your investment value will not change. What is X? Open your bracket, 500,000 minus 0.1136x is equal to 0. Collect like terms. negative 0.1336x is equal to negative 500. Negative, we cancel out negative. What is X? X is equal to 500,000 divided by 0.1136. Please work this out. 4,401,408. That is the number of put option needed. Put option. That is the number of put option needed for a proper hedge. The investor we need to buy 4,401,408 put option for a proper hedging. That is the expected response to requirement B. Please carefully study this. We are Christianity for all.
Nothing, sir. I wanted to be sure that it wasn't my network.
I can hear you now.
No,
On
I'm
mute.
fine, sir. I'm fine, sir.
Okay, I saw hello. That was what I was wondering. Now the last requirement. You continue to wonder, where would they use all these things? Boys, it's a financial market. If you find yourself in this environment, an hedging market, you are going to require option. It's a risk management strategy. Refer to positioning A. Calculate the investor's change in words. If she buys 500,000 put option to hedge her portfolio, and share price in 2 years' time is 30 naira per share or 100 naira per share. Let me try to explain this requirement. As of today, the current share price is 60 naira. Now the investor buys 500,000 put option. A put option. That put option will give her right to be able to sell her shares at a price agreed today. That put option will give her the right to be able to sell her shares at a price agreed today. That price agreed today is 50 naira. Now, she has taken the option. Examiner now says, assuming in 2 years' time, the share price happen to be 30 naira. How would this affect the investor's weight? We have two scenarios. Now look at scenario 1. The change in investor's weight is the total profit or loss made on the portfolio. Scenario 1, if the share price in 2 years' time is 30 naira, please remember two things. Or remember one thing. You are dealing with two markets. We have the stock market, where you can buy shares or sell shares. We have the option market, where you can hedge against fluctuation in your investment value. Let me repeat that point. Please bear in mind, there are two markets involved here. We have the stock market. The stock market is a market where investors buy shares or sell shares. We now have the option market. The option market is a market where investors can protect their investments against fluctuation in value. Now, let us try to reason this out. Assuming today the share price is 60 naira. If in 2 years' time the share price becomes 30 naira. What has happened to your investment at the stock market? I want to hear from you. I want to hear from the class. Today, share value is 60 naira. If in 2 years' time, share value happen to be 30 naira, what has happened to your investment value? Yes, who is speaking? IJ. Ijoma, are you there?
Hello, sir.
Yes, I'm here.
Okay, yeah. IJ, let's hear.
So for me, the shares are reduced to 30 naira as in loss also.
What has happened to your investment? Tell us.
It has reduced to 30 naira. I think it's a loss or
That
something.
means thank you. Your investment value has reduced. The investor will suffer a loss.
Mm.
Yes, Mustafa, let me hear your view.
Yes, I align with that.
Yeah. The share price is currently 60 naira. If in 2 years' time, the share price happens to be 30 naira, that means the investment has been reduced by 30 naira per share. Look at it, please. Loss at the stock market, loss. The share price is now 30 naira. What used to be 60 naira. Multiplied by number of shares, 50,000. The investor will suffer 15 million naira loss. The investment value will reduce by 15 million. This will happen at the stock market. We now move to the option markets. At the option market, the investor has obtained a right to sell our shares for 50 naira per share. That is the exercise price. Assuming you are the investor, you have obtained a right today to sell your shares at 50 naira per share in 2 years' time. On getting to 2 years, share price at the stock market happens to be 30 naira per share. And you have obtained a right to sell for 50 naira per share. The question is, will you exercise your right to sell or not? Let me hear from the class.
We exercise, sir.
I will exercise my rights. Any other opinion? Ọlọ́run tó sì.
I will exercise my right, sir.
I will exercise my right. That contract is in the money. You are going to sell for 50 naira. What currently worth 30 naira. Yeah, by making a profit of 20 naira. Look at it, please. This is gain. You are going to exercise your right. You are going to sell for 50 naira. What currently value as 30 naira. Thereby making a profit of 20 naira per put. And you have 500,000 put option. Look at it. The investor purchased 500,000 put option. The investor will gain 10 million naira from the option market. As a result of going into that contract, the investor will generate a profit of 10 million. But you must pay the premium. Premium. The put option. Premium. That is the price. The premium has been computed for 500,000 put option. The premium is 85500. Premium payable. What is the change in the word? Negative 15 million plus positive 10 million minus 855. You are going to have negative 5,855,000. Worth of the investor will reduce by 5,855,000. If scenario 1 should happen, the worth of the investor will reduce by 5,855,000. To appreciate what has happened, to appreciate what has happened, assuming the investor has not purchased 500,000 put options, she will have lost 15 million naira at the stock market. Assuming she has not taken an edge, she will have lost 15 million naira. By going to the option market to edge, the loss has been reduced to 5,855,000. You are done with scenario 1. Scenario 2. If the share price in 2 years' time is 100 naira, what currently worth 60 naira? The value has increased to 100 naira. That means our investment value has increased. Our investment at the stock market has appreciated. Look at it. Gain at the stock market. Share price is now 100 naira. What used to be 60 naira? You are going to gain 40 naira per share. Multiplied by the number of shares. The investors will get additional 20 million. Value of investment will increase by 20 million. That will happen at the stock market. We now move to the option market. At the option market, you have obtained a right to sell your shares for 50 naira per share. You have obtained a right to sell your shares at 50 naira per share. Assuming in 2 years' time, the share price at the stock market is trading at 100 naira. Now the question is, will you exercise your right to sell at 50 naira or not?
I will not.
Yes or no?
No, I will not. I will not exercise it.
Correct. The appropriate answer is no. I won't exercise my right. You obtain a right to sell at 50 naira. Now the price is now 100 naira. You are going to opt out of that contract. The rights will not be exercised. In that case, this is 0. 0 means you are not exercising your rights. But you must pay the premium. whether you exercise your right or not, the premium is 855,000. What is the change in the investor's wealth? 19 million. These two, 145,000. Investors' wealth will increase by 19 million, 145,000. Investors' wealth will increase by 19 million. You can check the group chat. We just shared a question on the group chat. This question was dated 2024. I think November died. Please refer to the group chat. Let us play with this question for 30 minutes. Then we are saying in brackets, Kenny is the finance director of Solar Engineering. Yes. Kenny has approached yourself to give a presentation to the board of Solar Engineering on the characteristics and the use of options in the following circumstances, in the following situation. Solar engineering has been expanding in recent years by acquisition. Kenny would like to know how his company might use traded options to protect itself against fall in the value of non-shareholding that is earned in potential acquisition. One of such potential acquisition is that property in which solar engineering owns as an holding on 31st December 2014. The following information is available. On 31st December 2014, the share price of ZP, Greco PSC, is 287 kobo. SD, traded options on the shares are available as follows. All figures in kobo. You have the exercise price, 280 and 290. You have call option. You have put option. Call option for March. Call option for January. Now the figure inside here. Under January, 8.5, 2.5. This is the premium. If you buy call option for January, exercise price 280. You are going to pay a premium of 0.5. For March, call option, premium of 16 covers. Requirement. Prepare fitting for presentation that include one. Calculation of the intrinsic value and the time value of each of the options on ZB share at 31st December 2024. What is intrinsic value? How do we calculate intrinsic value? Intrinsic value is the value of an option at maturity. Your intrinsic value is the option payoff value. I have explained this before, both with illustration and theory. Let us go to it. We only have 30 minutes. Calculation of intrinsic value. You start with call. The formula is for call option payoff, call option intrinsic value. Now is equal to maximum of 0, comma ST minus E. Value of call option at expiration. That is the intrinsic value. ST. Value of the underlying asset. The asset is your share. Capital letter E, exercise price. Now come here. At exercise price of 280. You are giving to exercise prices. You are going to take the first one, then the second one. Your share price. Share price will not change. Share price is 287 kobo. Calculate. 50 is equal to maximum of 0 or ST. Share price. You have a choice between accepting 0 or 7 kobo. Which one are you going to pick? 7 covers better. That is intrinsic value here. Is 7. The intrinsic value is 7 here. Let me expand this more. We have used 2 exercise price. Now let's take 290. Come here. At exercise price 290. What is the implicit value? Go back to the formula. Call again. CT is equal to maximum of 0 ST minus E. Maximum of 0 or your stock price 287. Exercise price is now 290. It choice between 0 or minus 3. In this case, you are going to choose 0. In this case, you are going to select 0. Intrinsic value is 0. You cannot pick negative. Negative implies that the option is out of money. The minimum that can happen is 0 for your intrinsic value. We have demonstrated using color. Now let's look at put option. For put option, at exercise price 2, what is the intrinsic value? Maximum of 0, look at it. Maximum of 0 or exercise price 280 stock price. The share price 287. Choice between 0 or negative 7. Intrinsic value here is 0. Then at exercise price, 250 is equal to maximum of 0 exercise price minus X 50 put price or put value, put intrinsic value, maximum of 0 exercise price 290 minus stock price 287, maximum of 0 or 3. In this case, intrinsic value is equal to 3. You have calculated intrinsic value. Next is your time value. Time value is premium minus intrinsic value. That's the question. Premium for January 5.5 March 1611. I'll pick this. Premium year 8.5, 2.5. $16 food. Premium for food, January 1.5, 10.5, 16. Premium for that put option from 10.16. Now our intrinsic value here 7. Under call option intrinsic value 7. Yes, sir. Under put option intrinsic value here 0. Year 3. Intrinsic value here 0. Year 3. Calculate your time value. Premium minus intrinsic value 1.5. Premium minus intrinsic value 2.5. Come to March. 16 minus 7, 9. 11 minus 0, 11. Come to put. 1.5 minus 0, 1.5. Minus 3. 5.5 minus 3, 2.5. 10.5 minus 0. 10.5. 13. You are done with requirement 8. You have calculated intrinsic value as well as the time value. You are done with requirement 8. You have calculated intrinsic value as well as the time value. Requirement B. A brief explanation of the three factors that can affect time value. What are the factors that can affect time value? The three factors that affect time value are: 1, the time to maturity of the time to maturity of the option. The longer the maturity, the more the option is worth. So the maturity period will affect time value. The longer the time to expiration, the more the option is worth. Number 2, the volatility of the market price of ZP share. The volatility of the market price. The extent to which the market price fluctuates. For example, if the share price becomes more volatile, this will increase the probability of the option becoming in the money or deeper in the money if the price volatility is high. That will affect the time value of the option. The number 3 factor, general level of interest rates. the general level of interest rates. Exercising the option will be at some point in the future. Hence, the value of the option depends on the present value of the exercise price. If the interest rate fluctuates, that will affect the time value of the option. Requirement C says, explain two factors that affect intrinsic value of the option. What are the factors that can affect intrinsic value? There are two factors. If you want to calculate intrinsic value, there are two variables you use: stock price and exercise price. Look at the computation for intrinsic value. Stock price and exercise price. These are the two factors that will affect your intrinsic value. You can explain. Factors that affect intrinsic value. One, the exercise price. For call option, the lower the exercise price relative to the share price, the higher the intrinsic value. For call option, the lower the exercise price relative to the share price, the higher will be the intrinsic value. For put option, the higher the exercise price relative to the stock share price, the higher will be the intrinsic value. Then the share price. Share price will also affect intrinsic value. As the share price rises, the option becomes deeper in money. The intrinsic value will increase. For put option, as the share price rises, the option becomes deeper in the money. Hence, intrinsic value will rise. For put option, as the share price falls, the option becomes deeper in the money. Hence, so please note, two factors determine intrinsic value. These are the exercise price and the stock price. The last requirement to round up this question. The requirement says we should demonstrate a demonstration using option of how foreign engineering can protect itself against fall in the share price in the period up to 31st March, when it will decide whether to make an offer for the entire share price for the owner of ZP. Assuming ZP share price will be 250 kobo. Let us explain that briefly. Currently, our company, Polar Engineering, we have shares in ZP. As of today, the share price is 287 kobo. Today is 31st March 2024. In 3 months' time, we expect the share price to fall to 250. How can we protect ourselves? We can do put option, right to sell our shares at a price agreed today. We can go into put option. Obtain a right to sell your shares at a price guaranteed today. So that if the share price should fall, you are taking a guarantee to sell my share at this price. Look at the demonstration. What the question is asking you is changing words. One, a put option at exercise price 280 kobo. We can do put option at exercise price 280. You have your stock market. At the stock market, the price is 287 kobo. If in 3 months' time, the price becomes 250, that means the investment value has fallen. Loss at the stock market. The price will be 250 kobo. What was 287 kobo? The investment value will reduce by 37 kobo. At the option market, you have obtained a right to sell your shares at an exercise price of 280. You have obtained a right to sell your shares at an exercise price of 280. If in 3 months' time, that is March ending, share price happen to be 250, will you exercise your right to sell or not? You have obtained a right to sell for 280. Exercise price 280. Stock price at the end of March 250. I'm going to exercise my rights. I'm going to sell for 280. What currently worth 250. Thereby, look at it, exercise price minus stock price at maturity. I'm going to get a profit of 30 kobo at the option market. Then the premium, put premium. Go back to the question. Premium. Exercise price 280. March, because this transaction will end in March. March premium is 10.5. Premium payable 10.5 kobo. Change in words. Minus 37 plus 30 minus 10.7. Negative 17.5 kobo. Reduction in weight. The weight of solar engineering will reduce by 17.5 kobo. To appreciate what has happened, if solar engineering has not gone into option market to buy put option, the company will have suffered 37 kobo per share loss. The option market has assisted the company to reduce the loss. Then second, put option at exercise price 290 kobo. This can also be used to hedge. Again, the stock market. At the stock market, invest the share value that was 287 kobo in December. In March, is going towards 250 kobo. The investment value has fallen. 250 minus 287. Investment value will reduce by 37 kobo. At the option market, you have obtained a right to sell your shares for 290 kobo at the end of March. If the share price happen to be 250, You are going to exercise your rights. Gain. You are going to sell for 290. What is now selling for 250. You are going to make a profit of 40 kobo. But you must pay the premium. Put premium for March. Size price 290. We are done. The premium is 16. Premium payable 16 kobo. Changing what? 13 kobo. Reduction in weight. Weight of polar engineering will reduce by 13 kobo per share. If it buys a put option at an exercise price of 290. Instead of suffering 37 kobo per share loss, the loss has been reduced to 13 kobo. Option market can be used to reduce your investment loss. We are done with this question. And we are done with the topic. We have solved 3 questions. We call it a good night.